Hello friends, this is our 8th video lecture and it will be about IFRS 13 fair value measurement. So, fair value measurement, IFRS 13 fair value measurement provides overall guidance and principles for measurement of fair value, and it is used as a guidance by other related standards, for example IAS 16 property, plant and equipment, IAS 40 investment property, IAS 41 agriculture, IFRS 9 financial instruments. IFRS 13 fair value measurement contains a list of measurement rules. It provides consistency and comparability of fair value measurements. The objectives of IFRS 13 are to define fair value, to present a single IFRS framework for measuring fair value, and to present requirements for disclosures about fair value measurements. Fair value definition. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Orderly transaction means non-forced transaction. It means that entities would like to make such transaction. So, fair value should be thought of as an exit price. What does it mean? What is exit price? This is actually the first part of the definition. The exit price is a price that would be received to sell an asset or paid to transfer a liability. That is the exit price. Fair value should be determined independently of the reporting entity's intent or ability to actually sell the asset or transfer the liability. Fair value is a market-based measure. It is not an entity-specific measure, which means that fair value must be, first of all, based on market data. Orderly transaction definition. The transaction is orderly when two key components are present. If there is adequate market exposure in order to provide market participants the ability to obtain knowledge and awareness of the asset or liability necessary for market-based exchange. Market participants wish to transact for the asset or liability, which means that's non-forced transaction. Framework for applying the definition. The standard states that we must identify the following: the particular asset or liability that is the subject of the measurement. In the case of non-financial assets, the best use of the specified asset, the principal or the most advantageous market for the asset or liability, the valuation technique appropriate for the actual measurement. Measurement of fair value should be based on an orderly transaction to sell the asset or transfer the liability in either the principal market, which is market which has the highest volume or level of activity, or in the absence of a principal market, the most advantageous market, which is market which maximizes the amount which would be received to sell the asset or minimizes the amount that would have to be paid to transfer a liability. Valuation technique. There are three approaches for valuation of fair value. The first one is a market approach. It is based on market transactions involving identical or similar assets or liabilities. The income approach, it is based on future amounts, typically cash flows or income, that are discounted to their present value. The cost approach links fair value to the amount required to replace an asset in its current condition. Hierarchy of inputs. In accordance with IFRS 13, there are three levels of hierarchy of inputs. First one is level 1, involves unadjusted quoted prices from active markets for identical assets or liabilities. This is the level of high priority, the highest priority level. The second level includes inputs which comprise of quoted prices coming from non-active markets or from active markets, but for assets or liabilities which are similar instead of identical. Observable inputs other than quoted prices, inputs that are not directly observable but are supported by observable market data. And level 3 includes inputs that are not observable. One of the purposes of IFRS 13 is to increase usage of level 1 and level 2, to increase the usage of observable inputs, and to minimize usage of unobservable inputs, which is level 3. So let's move further. Let's look at simple example. Our entity Fluffy Kitten. In Fluffy Kitten accounting records, the value of financial assets is $875, while their market value is $925. Fluffy Kitten wants to measure its financial assets at fair value. Which adjustment does Fluffy Kitten need to book in order to correctly present its financial assets at fair value? So, we see that market value is higher than the book value of financial assets by $50, which means that we must increase our financial assets, so debit financial assets by $50 and credit our profit or loss for $50. So that is the end of lecture number 8. I hope it was useful. Thank you very much for watching this video, and bye.